Welcome to TalkTickers, your go-to source for critical earnings call insights. Today, we're taking a deep dive into the Q2 2025 earnings call for Johnson & Johnson. And this quarter, well, it truly stands out, clearly exceeding expectations and signaling some really strong momentum.
Yeah, accelerated momentum, I'd say, across the board for this healthcare giant.
Definitely. Our mission today is to cut through all the noise, give you the vital numbers, the strategic shifts, and what's happening in the pipeline, the stuff that genuinely matters.
Exactly. So you're fully informed on where J&J is headed.
We want you to understand not just what happened, but why it matters.
Especially as they navigate some pretty big industry shifts and honestly seem to be coming out stronger.
Okay, so let's kick off with the headline figures. The results snapshot. Johnson & Johnson delivered a truly robust second quarter, outperforming expectations top and bottom line.
Yep. Worldwide sales reached $23.7 billion for the quarter.
And operational sales grew by a solid 4.6% across the entire business. Yeah, it's pretty healthy.
What's fascinating here, though, is the geographical split. U.S. growth was particularly impressive, 7.8%.
Oh, okay.
While outside the U.S., it was, more modest, around 0.6%.
So clear domestic strength there, strong market capture right at home.
Exactly.
All right, diving into the segments. Innovative Medicine, that's their pharma division. How does they do?
They reported 3.8% operational sales growth. And get this, they hit over $15 billion in quarterly sales for the very first time.
$15 billion in a quarter. That's a huge milestone for them.
It really is. And their MedTech, the medical devices arm, it actually showed even stronger momentum.
Oh, yeah.
6.1% operational sales growth there.
Okay, so strong across both main divisions. What about earnings per share?
Right. So adjusted diluted EPS came in at $2.77. Now, that is a slight decrease, 1.8% compared to the prior year.
Okay. Why the dip then?
Well, management pointed to two expected impacts. First, increased interest tied to the Intra-Cellular acquisition debt.
Oh, okay. Makes sense.
And second, critically, the anticipated loss of exclusivity, the LOE for Stelara, their multi-billion-dollar drug.
Right, Stelara. That LOE is a massive headwind for any company. I mean, that's huge.
Absolutely huge.
So can you elaborate on just how significant that impact was? And, what levers did J&J actually pull to not just weather it, but keep growing?
Well, it was substantial. It contributed a 710 basis point headwind to worldwide growth. That's significant.
700 points, wow.
But this is where J&J's diversified model, their portfolio really shines. Acquisitions like Intra-Cellular and Shockwave, they provided a positive boost.
How much?
About 160 basis points. So helping to offset a big chunk of that Stelara hit.
Okay, so acquisitions playing a key role.
Definitely. And management highlighted something quite interesting. They said no other healthcare company has actually grown through the first year of a multi-billion-dollar product's LOE.
Really? No other company?
That's what they stated. Yet J&J is doing exactly that. And it's fueled by broad-based strength, double-digit growth across, I think it was 13 key brands.
13 key brands growing double digits.
Yeah.
So it's not just one or two stars carrying the load then?
Not at all. It's truly broad. You're talking about big names like Darzalex and Oncology, Spravato and neuroscience.
Right.
Alongside these newer, rapidly scaling assets, it's that deep bench that let them absorb the Stelara challenge.
That makes sense. So where are these players really making their mark? Let's zero in on innovative medicine first, particularly that big push into oncology.
Absolutely. Oncology saw operational sales growth surge, an incredible 22.3% in Q2.
22%.
Yeah. And J&J has this bold ambition, right? They aim to be the #1 oncology company by 2030.
Targeting over $50 billion in sales, I heard.
Exactly. It's not just a number. It's about rapidly gaining share in a very competitive space. And these Q2 results suggest they're ahead of the curve.
That's quite a statement. Okay, let's break down oncology a bit. Multiple myeloma.
Yeah, Carvykti sales are climbing fast, hit $439 million, growing over 100%.
Wow. Driven
mainly by expanding their manufacturing capacity. But here's something really interesting for the future.
Go on.
An investigational tri-specific antibody, cutting-edge stuff designed to hit cancer from 3 different angles.
Right.
It showed an unprecedented 100% overall response rate.
100%. In which patients?
In heavily pretreated patients, a really difficult group to treat. Every single patient saw a significant positive response.
That is genuinely remarkable.
Oh.
Okay, what about lung cancer?
The chemo-free combo, Rybrevant+Lazertinib, delivered sales of $179 million, also growing over 100%.
Another one over 100% growth. Strong launch uptake then.
Very strong. And they mentioned intent to prescribe continues to grow among doctors, so good physician confidence.
And then bladder cancer, this one sounds like it could be a sort of a sleeper hit. TAR-200.
Yeah, they got FDA priority review for TAR-200. It's a first-of-its-kind drug-releasing system, projected launch later this year.
And management seems really bullish on this one.
Extremely. They expect it to generate at least $5 billion in annual peak sales. And they see a significant disconnect with the market.
How big a disconnect?
They explicitly said they think the 2028 consensus is at least 3 times too low.
3 times too low. That's a bold claim. Very intriguing.
Definitely signals they see a huge opportunity there.
Okay, moving across innovative medicine. Immunology.
Tremfya grew an impressive 30.1%. Strong uptake in Crohn's and ulcerative colitis.
And that's another potential blockbuster, right?
Expected to generate at least $10 billion annually in peak sales. And they're planning to file icotrokinra, a targeted oral peptide, with the FDA in Q3.
An oral option there could be significant.
Could be. Potential once-a-day pill with efficacy maybe similar to injectables.
And neuroscience. Spravato was up significantly, too.
Yeah, Spravato grew 53%. Incredible growth.
What's driving that? Broader adoption, new indications.
Seems to be largely increased adoption, strong clinical evidence driving prescriptions. Plus, remember that Intra-Cellular Therapies acquisition.
All right, that adds Caplyta.
Exactly. And Caplyta itself has over $5 billion peak sales potential. Plus, it's expected to get approval for major depressive disorder later this year.
So really bolstering that neuroscience portfolio further?
Precisely.
Okay, that's a powerful story for innovative medicine. But what about the other side of J&J's business? MedTech, how's that contributing?
MedTech is showing significant momentum, too. Cardiovascular delivered over 22% operational sales growth.
22% in cardio. What's driving that?
New product performance, mainly. Abiomed, that's their Impella heart pump tech, grew nearly 17%. And, of course, the recent Shockwave acquisition is contributing.
Right, Shockwave.
Electrophysiology, or EP, that's for heart rhythm disorders, grew nearly 10%. Their Veripulse system, which is new,
Yes.
it showed really impressive safety across over 10,000 global cases, a neurovascular event rate of less than 0.5%.
Less than 0.5%. That's a very strong safety signal.
Very strong. And Shockwave, you mentioned it, it's expected to become J&J's $13th billion medtech platform by the end of this year.
13th platform over $1 billion. Really underscores the impact of that acquisition.
It does. Then in surgery, a key highlight was introducing the Ethicon 4000 surgical stapler,
Okay.
designed specifically for future use on their Otava robotic surgery system.
Ah, the robotics connection. How's Otava progressing?
Well, the system completed its first clinical cases in Q2, and they're planning the FDA de novo submission that's for novel, lower-risk devices for Q1 next year.
So a crucial step for their robotic strategy, positioning them for the future there.
Absolutely. It's a competitive space.
And finally, vision.
Vision saw overall growth of 4.6%. Surgical vision was stronger, up 8.9%.
Any new launches driving that?
Yeah, they mentioned the first disposable multifocal lenses for people with astigmatism. AccuView Oasis Max one-day multifocal for astigmatism, expanding their reach.
Okay, let's look at the financials behind this. Efficiencies, margins.
Well, they continued strong R&D investment, $3.5 billion in Q2 alone.
Still investing heavily in the future then.
Definitely. No, innovative medicine and medtech margins did see some declines.
Yeah.
Mix, macro factors,
Okay.
But overall, selling, marketing, and admin expenses actually improved. They cited corporate rationalization efforts there.
And cash, how's the cash position looking?
Pretty impressive. Free cash flow through the first half was over $6 billion.
Wow.
And they ended Q2 with $19 billion in cash, even after paying for Intra-Cellular.
So significant flexibility for future moves. Bolt-on acquisitions, perhaps?
Or pipeline investment, share buybacks, lots of options.
Okay, let's pivot to management guidance. What are they telling us about the full year?
They raised the full-year operational sales guidance by about $900 million.
Raised guidance. That's a strong signal.
It is. They now expect 4.5% to 5.0% growth for the year.
And earnings.
Also raised. Adjusted EPS estimate up by 25 cents to $10.85.
What's behind the raise? Operations. Currency.
A combination, they said. Operational improvement and also favorable foreign currency dynamics helping out.
What about operating margins for the full year? Any change there?
No, they reiterated confidence in achieving that approximate 300 basis points improvement for the full year,
Okay.
citing efficiency programs again. And here's another interesting detail. Tariffs.
Ah, yes, the tariff impact.
They reduced the anticipated impact for 2025 down from $400 million to $200 million.
Have it. That's significant.
Yeah, and it's exclusively related to the MedTech business. But here's the kicker.
What are they doing with the savings?
Reinvesting the difference directly into pipeline acceleration.
Ah, very strategic. Funneling savings right back into future growth. I like that.
Me too. They also mentioned the One Big Beautiful Bill Act.
How did that play in?
Provides certainty for their big $55 billion commitment to invest in the U.S., includes permanent expensing for domestic R&D.
So a legislative tailwind helping incentivize that innovation.
Exactly. A positive factor for their long-term strategy.
So pulling it all together, what's the outlook for the rest of the year? Sounds like they expect things to pick up even more.
Yeah, they're clearly signaling elevated growth in the second half across both innovative medicine and MedTech.
Driven by
New product adoption, think Carvykti, Rybrevant, and these anticipated major approvals. TAR-200 in bladder cancer.
right.
Subcutaneous Rybrevant for lung cancer. Caplyta for MDD. Quite a few catalysts lining up.
Okay. So when you step back, what's the big picture takeaway from this quarter for investors, for people watching J&J?
Well, I think this quarter powerfully demonstrates how that unique, diversified model, pharma and medtech, gives them a resilient base.
Resilience to navigate challenges like the Stelara LOE.
Exactly. And leverage those high growth areas. It's really a story of strategic adaptation, managing that LOE incredibly well.
And the pipeline. You really need to pay attention to the sheer volume of catalysts they discussed.
Absolutely. The number of late-stage assets, upcoming approvals, particularly in oncology and medtech, it suggests a really strong foundation for sustained growth.
Not just for the rest of this year, but looking out, well into the back half of the decade.
Right. And despite some of those segment margin pressures we mentioned, management reaffirming that full-year operating margin improvement.
And strategically reallocating those tariff savings.
It signals, I think, a really disciplined approach, balancing today's performance with driving that long-term value, setting themselves up nicely.
Okay, great summary. Let's switch gears now for our not financial advice segment.
Always the fun part.
Right. Remember, everyone, this is purely for thought-provoking discussion, not financial advice. We're looking at some, let's call them outrageous but plausible trade ideas, like an analyst pitching an investment committee.
Okay, I'll go first. Idea 1. The bladder cancer bonanza long play.
Intriguing name. What's the pitch?
Go along Johnson & Johnson, but structure the position specifically to benefit from that TAR-200 launch we talked about.
Because management was so bullish on it.
Exactly. They explicitly stated they believe the street's 2028 sales consensus is at least 3 times too low for an asset they see hitting over $5 billion peak annual sales.
That's a direct signal of potential mispricing.
A very clear signal. They think the market is significantly undervaluing a potentially transformative product, especially in an area, bladder cancer, that hasn't seen much innovation lately.
And the catalysts are near term.
Yep. FDA priority review, anticipated launch in the second half of this year. So why is it plausible?
Well, if J&J is even, say, half right about that disconnect.
Right. Even if they're only partially right, the market is severely underpricing this one asset's contribution. That could offer substantial upside and potentially lift the whole stock.
Okay, plausible indeed. What's idea number 2?
Let's call this one the MedTech resurgence option play.
Options, okay, bullish.
Definitely a bullish option strategy on J&J, specifically targeting that accelerated growth in the MedTech segment.
Even with orthopedics still being a bit challenged.
Yeah, acknowledging ortho is still tough. But look at cardio, over 22% growth. Look at the turnaround in vision, especially with those new lens launches.
And the robotics potential with Otava's FDA submission next year.
Exactly. It suggests a segment that might be on the cusp of a significant re-rating by the market.
So why is this one plausible?
Management's confidence. They talked about continuous acceleration into the back half of the decade. Combine that with the reduced tariff headwinds.
Right, freeing up cash for investment.
You could see stronger than expected segment performance that maybe catches the market a bit off guard.
MedTech's Q2 definitely showed improvement sequentially.
Yeah.
And that pipeline in high growth areas like EP and robotics could drive share gains that aren't fully baked into the price yet.
That's the idea. The market might not have fully priced in that MedTech momentum and pipeline potential yet.
Okay, two interesting, potentially outrageous but plausible ideas there.
For discussion purposes only, of course.
Absolutely. So to recap this whole deep dive, this quarter was a really powerful demonstration of J&J's ability to innovate and grow, even facing a massive headwind like the Stelara LOE.
The strength of that diversified portfolio, that robust pipeline, it promises elevated growth for the rest of 2025 and likely beyond.
So here's a final thought for you, the listener, to consider. How does Johnson & Johnson's dual-pronged strategy, innovative medicine and medtech, how does it uniquely position them to tackle some of the world's biggest healthcare challenges?
And, how much of this diversification and pipeline strength is truly reflected in the current valuation? Where might the next unexpected growth driver emerge from within this vast company? Something to chew on.
Definitely. Well, this was our in-depth summary of Johnson & Johnson's Q2 2025 earnings call, provided, as always, for informational purposes only.
It does not constitute financial or investment advice. Please do your own research.
We absolutely encourage you to delve deeper into the areas that sparked your interest and continue your own analysis. And we always welcome your feedback and questions. Thanks for joining us for this deep dive on TalkTickers.